All right, welcome to Talker Tickers. Today, we are breaking down HDFC Bank's Q3 fiscal 24 earnings call. What's really interesting here is that management actually held this call on a Saturday. That gives us a unique chance to analyze everything before the markets have a chance to react. So let's dive right in.
Okay, so let's get right to the heart of it. For the past few quarters, really, the entire debate around HDFC Bank has boiled down to this one simple question. Is the bank just stuck with a kind of post-merger funding hangover? Or is this still that best-in-class compounding machine that investors have loved for years? Well, these Q3 results give us some pretty critical clues.
First things first, let's hit the headline scorecard. And honestly, this quarter was a classic case of a beat and a miss.
So, on the bottom line, they delivered. Earnings per share came in a penny ahead of what analysts were expecting. A small beat, but a beat nonetheless.
But when you look at the top line, revenue, they came in just a little light. They missed the consensus by about $13 million.
Now here's where it gets really interesting. When you look beyond those main US-listed numbers, in their local currency, the net profit beat was actually more substantial. But the number I'm really focused on, the crucial one, is the net interest margin, or NIM. It actually expanded by 8 basis points from last quarter. That's a really strong sign of profitability, especially in an environment this competitive.
So, if profits are looking good and margins are expanding, what gives? Why has the stock been dragging, down about 7 to 8% over the last 3 months? Well, the answer isn't in the profit and loss statement. It's hiding on the balance sheet. The entire story this quarter is about one metric, the credit-to-deposit ratio.
Now, for anyone who's not deep in the banking weeds, the CD ratio basically measures a bank's total loans against its total deposits. You can think of it like a funding gauge. When it gets too high, it's a bit of a warning light. It means the bank is lending out pretty much every dollar it brings in, and that can signal real pressure to find more funding to keep growing those loans.
And here you can see the market's concern in plain numbers. HDFC's CD ratio is sitting at 99%. 99. Meanwhile, management's own target is a much more comfortable 90%. So closing that gap has become the bank's absolute top operational priority right now.
And you have to remember, all of this news dropped in a bit of a vacuum. The call was on a Saturday, and Monday is a U.S. market holiday. So the first real price discovery, the first real reaction, is all going to happen at the opening bell on Tuesday. This sets up a really fascinating dynamic for investors watching this stock.
Okay, so the problem is crystal clear. The big question is, what is management's plan to fix it? Well, they laid out a very specific glide path, as they call it, to normalize their funding base and get back to business as usual.
They've broken their strategy down into 4 pretty clear steps. First, they're going to invest in their physical footprint. Second, they'll execute on gathering deposits. Third, they'll use those deposits to normalize that CD ratio. And finally, once they have that secure funding base, they plan to re-accelerate loan growth. Invest, execute, normalize, accelerate. That's the game plan.
And believe me, that invest phase isn't just talk. They're putting some serious capital to work here. We're talking about plans for around 500 new branches. And get this, a massive hiring spree of about 7,000 bankers and another 30,000 support staff. The goal here is pretty simple. Build a much bigger funnel to capture all those low-cost deposits they need to power their growth engine.
And you know, management's tone on the call was just resolute. The CEO, Shashidhar Jagdishan, was totally explicit. He said, and I'm quoting here, "We're very confident that whatever we seem to have committed, we should sort of achieve." This doesn't sound like a team that's just crossing their fingers. They're communicating a clear, executable plan.
So, with the numbers in and the glide path all laid out, what's our call? How should investors be thinking about this stock heading into next week?
So here's how the debate really stacks up. The bulls are going to point to that solid profit beat, the expanding NIM, the pristine credit quality, and a confident management team that has a clear plan. But the bears, they're going to fire back, focusing on that lingering high CD ratio, the slight miss on revenue, the execution risk of such a huge expansion, and of course, the stock's recent weakness.
After weighing both sides, our call here is outperform. We just believe the positives from this quarter, especially the clarity of their strategic plan, really do outweigh the perceived risks.
The whole investment thesis here is built on a narrative shift. For a while now, the market has been pricing HDFC as a funding problem stock. We believe this earnings call is the catalyst to start re-rating it as a recovery story. In our view, the clear guidance on fixing that CDR ratio is going to overshadow the minor revenue miss.
So the trade idea is to position long before the market opens on Tuesday, anticipating that this new narrative is what's going to drive the stock higher.
And as always, just a reminder that this analysis is for informational purposes only and is not financial advice.